This is the 2025 Forex Trading Empire Mentorship Program, Lecture 27. The topic for this lecture is 2025 model. It's the one model for life. So the reason I use the bracket and indicate a one model for life is trying to tell you guys that you only need one model to be profitable. You just need to grow upon that model, advance that model, and trade it correctly. One trade plan is all you need. Then later on, you develop more on how to trade that one trade plan. Develop a trade plan and trade that trade plan. So the 2025 model is all about one trade plan, but there are many ways to trade that trade plan, in creating other ways to fit your own schedule, your own timing, or the way you accept risks. Because there are some traders that cannot take multiple losses in a row on the same day, so they mostly stick to taking day trades where they are holding one trade, they're aiming for at least one trade a week, taking trade between the weekly intervals. So you can customize this model to your own best time preference. That's the main point of it. But the model is still based off the same basics. Yes. So throughout the 2025 model on the previous lecture, I've been talking about one model, but different ways to apply it. Where I talked about the weekly model, the daily model. That have been one of the most talked about topic in this 2025. All is still one model. It's just knowing the basics of the model. Then you look for a way to customize it to your own preference, where you either take your entry from another block, fair value gap, 3 a.m. to the 4 a.m. entry model, or 7 a.m. to the 8:30 entry model, or 8:30 to the 10 a.m. entry model, whatever way you feel to customize this one model, but you just need to understand the basics of the model. So going through this lecture, I'll be talking about the whole basics of the 2025 model. What are the steps you need to follow to build up a trade plan? Then I'll talk about ways you can customize it to your own personal preference or ways to look for a specific trade plan through the model in this 2025 model and is the only model you need for life. So first is the step in building a trade plan. We're talking about the steps in building this trade plan, how this trade plan is being built. And the steps are very easy. First is the trading type or style. You need to know if you are going to be a position holder, a weekly trader, a day trader, an intraday trader. That's the type of trading. What is your time interval on how will you be looking at the charts? Second is your higher time frame bias. You need to understand the open, low, high, close. There's the OLHC and the OHLC, open, high, low, close theory. This is understanding an individual candle from the opening price to the closing price. We are basing this model off individual candle. We are trying to anticipate what an individual candle would do. That's the whole baseline of this model. So your higher time frame bias is going to come from your anticipation of where is the next weekly candle, daily candle, monthly candle is going to trade to, depending on your trading type or trading style. Second is your mid time frame. So the mid time frame trend is the trend you use in looking for liquidity pools, fair value gaps, which will tell you the price is on a discount or on a premium. This is where you understand the trend. You need to understand the trend of the mid time frame because it's going to give you the full confirmation to know what to do or when to go to your lower time frame for your entry. So understanding your mid time frame is one of the baseline in this 2025 model, which I've talked about it in the previous lecture. I think it's not a new topic, but I'm dedicating this specific lecture for traders that still have those questions. So they are asking me about how to align the time frame correctly or how to use the 2025 model, still contemplating on how to do it and still having some few mistakes I hope this lecture will correct. Is going in into the chart, not knowing on which time frame to pick your ideas from or which time frame to look for your narrative. because the whole thing about trading is about anticipation and narrative. First, you read the narrative, then you anticipate where will price trade to next. So, if you can align this time frame correctly, knowing where you are anticipating the next candle to trade to, then try to have a narrative of the mid time frame and anticipate what does price need to do to align to your bias. Those are the narrative and the anticipation you're putting together. You need to have a narrative to anticipate price. And all will be done with the higher time frame bias and the mid time frame trend. Next is your entry time frame. I should have used entry model, but entry time frame and the time frame you use for your entry or the model you use in entry. You can directly use from the mid time frame is possible, which is going to be giving you those bread and butter setups where you're aiming for a 1 to 2 or a 1.5 hour trade or a 2 hour trade, just giving you that clear perspective on where price is trading to, and you are getting involved regardless of your entry level. So there are many ways to enter the price as long as you know where price is trading to and you know how to manage your risks correctly. So first, let's talk about the first trading style. What is your trading style? Now, this table is giving you a baseline on how to align your trading style. If you're a swing trader, you know that you're picking your buys from the monthly time frame, which means you're looking at the monthly time frame to anticipate the next monthly candle. Second is the confirmation trend, which is the mid time frame trend. You look at the daily time frame to look at your bias to see if the trend is aligned with your monthly time frame bias, because you need it to present that price level to show the price is below the opening price, which is going to be on the manipulation phase, and is seeking a liquidity below the opening price, seeking the sell side liquidity. Those sell side liquidity will be identified from the daily time frame. When price run out that sell side liquidity, you're going into your lower time frame, which is going to be the entry time frame, which is the 1 hour. After the run on the sell side liquidity, wait for a market shift, use the entry time frame, the 1 hour time frame for your entry. After the market shift, you can either enter from the fair value gap or the other block. Now, you can see how easily it is to align it. Now, you can still make some customization to it where on the confirmation trend, you're still looking at the 4 hour to have more narrative on where price might trade to, but those will be done specifically by you. You're the one going into the charts, doing the back testing, doing the work to know how to customize it. I'm only giving you the baseline. This is where you start from. These are the time frames you use when starting. So as a day trader, if you're day trading, your bias will be the weekly time frame. Confirmation trend will be the 4 hour time frame, which you can still involve the 1 hour time frame for more narrative. And your entry will be from the 15-minute lower. I just put the 15 minutes so that you guys can do your own personal customization to know how you choose an entry in the market. You can still use the 15 minutes and the 5 minutes, but these are the baseline you can start with. So for intraday trading, you use the daily time frame for your bias, anticipating the next daily candle, high or low candle, whatever one you anticipated from the daily chart. Confirmation trend will be the 1 hour trend where you're looking for a discount liquidity for price to run the discount liquidity or the premium liquidity. That is if you were to sell. If you were to buy discount liquidity, run to that discount liquidity. You use a 5 minutes, wait for a shift in market structure, execute, and you can align it with time correctly. You need to know that every market do move on a specific times. The London section, the Q zones, and later on I will dive deep into those micro time frames, those 60-minute intervals for you to get the best setups. I've talked about the 3 a.m. to the 4 a.m. is a 60-minute interval that will provide a good setup. Mostly if you're an intraday trader, scalper, and day trader. It doesn't apply much to a swing trader because you're entering from a 1 hour time frame, but you can still customize the weekly time frame to use the 1 hour time frame from entry, and then you can still pay attention to the 60-minute time frame. So, scalp trading, you want to be a scalper. If you're a scalper, you mostly base your bias off the 4 hour, but always have that perspective from the daily time frame. Always try to know what's the likelihood of price trading higher on that daily candle which you're trying to scalp. Then you go to the 4 hour to wait for those right moments when the 4 hour candle is ready to expand higher or expand lower. Then you go to the 15-minute time frame to look for those trend retracement to a fair value gap, whatever price level you use for your confirmation to enter from. Either you run on the sell side liquidity or on a fair value gap, shift market structure, execute on the 1 minute. So you can still apply the time correctly with the 3 a.m. to the 4 a.m. entry setup and the 8:30 to the 10 a.m. entry setup with this scalping time frame. You just need to know how to use your 4 hour correctly. I talked about this mostly on the 2025 lecture. I think the 2025 lecture I talked broad wide on many models. Mostly I did talk about the 2025 model, which is this model, but I still talked about trading without a daily bias using the intraday section as your bias. I talked lots lots models about the trading style I do trade on. Now I don't know those models, but it's not that I trade all at once. There are specific times where I use those models just for confirmation. But 2025 is all about this model and this time frame alignment. This is how to align your time frame correctly. If you're a scalper, you know the time frame to use correctly. If you're an intraday trader, you know the time frames to use correctly. If you're a day trader, you know the time frames to use correctly. And if you're a swing trader, you know the time frames to use correctly. Now we talk about the power of three because for you to know the open, low, high close or the open, high, low close of every individual candle, for you to trade it on that mid time frame, you need to understand the power of three. So the power of three is understanding that in every price range, there's a three-phase price pattern: accumulation, manipulation, and distribution. From the opening price to the closing price. Now, in the previous lecture, I talked about the same power of three. The reason I'm bringing it back is for you guys to know the basis. These are the basics of this model. You know what a fair value gap is. I'm not going to go deep into that. I'm only showing you how to structure your own trade plan. Let's say you decide to trade as a weekly because I'm settling down to trade the weekly candle. Every open price of a weekly candle to the closing price of a weekly candle, determining my price from the weekly candle, then aligning it with the daily. This is well customized to my own preference. You can do yours by doing the back testing. When you do the back testing, you can customize yours to your own personal preference. In every weekly candle, there's an opening price, there's a low price, there's a high price, and there's a closing price of that candle when the candle trades as a bullish candle. Why? On the down close candle, there's an opening price of that candle, there's a high price of that candle, there's a low price of that candle, and there's a closing price of that weekly candle. Every week you're trying to anticipate where will price create this model. Is it going to be an open, low, high, close, or an open, high, low, close? This is the theory. Within this price range, you're looking for your entry. Below the opening price, these are where you'll be looking to take your buy. Targeting liquidity above the opening price to anticipate price to trade above the opening price to form the high of the day or of the week, which in this example, I'll be using the weekly perspective. The high of the week, anticipated price to run maybe previous week highs, buy side liquidity above the opening price. Looking to enter at the low of the opening price, targeting the liquidity above the high of the opening price. In a sell scenario, opening price could create the high of the week. You look to sell to target the liquidity below the opening price of the week. sell side liquidity, previous week low, and fair value gap we fill on a weekly fair value gap. So the many liquidity pool you can use for your target, many reference points you can use for your target. Understanding that this is how you derive your bias. Now going more into the power of three. On a classic buy day, the accumulation phase is from the opening price. Whenever a candle open, those are the accumulation phase where they are going to be accumulating liquidity. Then they trade below, enticing traders to sell, which is going to be the manipulation phase. Enticing traders to sell, that is going to be mostly going to be the wick below a bullish candle, which you can see the label. Below the candle, these are the manipulation. At this point, most traders will be looking at price as a sell, and where's their stop loss going to be? Above that opening price. Stop loss will be either at the opening price or above the opening price. So that's why it's called the accumulation phase. Now their liquidity at the accumulation phase. Then price trades back, run out those liquidity, trades above the opening price, trade to a complete distribution, run on previous week high or previous week fair value gap or buy side liquidity. So there are many areas to target as long as you know your reference points. Next, the distribution, which is how price distributes after manipulating traders, running out their stops, trading higher. This is a classic buy day. Now, in that classic buy day, from the accumulation, the distribution below the opening price, then a trade above the opening price, running out stop losses at the opening price, distributing higher. In a candle phase where you're looking at price from the lower time frame perspective, it's going to be from the opening price, trading lower to run a sell side liquidity trade, a trade continuation where you see price, we're expecting order blocks, fair value gap, leading to higher prices before the closing price. Now, there are ways, I call it the two phase of every candle. There are two phases of every candle. Is that you're trading the main reversal points from the manipulation, or you're looking to trade the continuation in the distribution phase, which I will talk more once we move to the next slide. But understanding that this is going to be your target. Your higher time frame, you're anticipating an upwards candle. On your lower time frame, you're monitoring the bias. You can see how price traded lower, took out this candle slow, created a high, retraced back to two down close candle, was a two down close candle, and order block. The most sensible part of this is going to be the week. Retrace back to the week, we expected the week, higher prices. Price created another order block, retracement, relaxed at the open of the price. You can see how price stopped, traded higher to form the complete distribution. So this is going to be the reversal point. This is going to be the trend continuation phase. Those are the two phases I look to enter from. Either I'm looking to enter straightly from the reversal point where price is going into that liquidity pool, looking for my entry at that level, or I wait for a continuation when price is now trading to the next draw on liquidity from the weekly time frame, which is going to be the buy side liquidity or a previous week high. Now on the trading view chart, here's an example of a 1 hour chart looking at it from a perspective of anticipating a higher daily candle. This is where this example is built from anticipating a higher daily candle. Now, I'm going to talk about the two phase where you'll be looking to enter from. First is the manipulation phase. Here's the opening price. Now, below this opening price, you can see how price traded down with this week. And where's this week going for? This sell side liquidity. Price took at this sell side liquidity. This is where you look to enter from your lower time frame entry model. You look to enter after a run on the sell side liquidity. The next drawn liquidity is going to be a liquidity above this opening price, which is going to be the buy side liquidity. This is the first phase, trading below, looking for an entry below the opening price. Price trades took out the buy side liquidity, which is this high. This is the first model or the first phase. You're looking for that reversal point below the opening price, that manipulation point to accumulate your position for price to go for the opposite liquidity. Price to out sell side liquidity is not going for your buy side liquidity. This is the first phase. Now the second phase is the continuation. Now price is above the opening price, but the previous day high is at this high, which means there's still liquidity resting above this high. If we're anticipating an up close candle, our next drawn liquidity is going to be the previous day high. Price is already above the opening price. We're not going to be waiting for price to trade below the opening price again because price already took out the liquidity below the opening price, running out the sell side liquidity, which means we are in a trend continuation phase. We are anticipating a complete distribution to the next draw or liquidity. Now, how you execute on this, very simple. Retracement, if you want to see a trend, retracement to a reference point, fair value gap, and an order block. Price created a new high after retracing to this fair value gap. Price created a new high, retracement, order block, respected the order block, created a new high. Now you're anticipating a trend continuation. Here's another block. One, two, three, three consecutive candles, and there's a fair value gap. What the price did, retracement, fair value gap, respected the fair value gap, traded higher, and price to run out the buy side liquidity. During this trend higher to the buy side liquidity, you're using the mid time frame to look for reference points that will lead to a continuation in price. You want to see price trade to a discount from your mid time frame. Look for your entry at a discount price. Anticipate price to go for your previous day high or the next draw on liquidity on that time frame. Executing from this other block, your next draw on liquidity will be the buy side liquidity. Executing from this fair value gap, your next draw on liquidity is going to be the buy side liquidity. But your overall bias, which is your overall target, is going to be the previous day high. But just these little moves is well enough to give you enough setups. So the 2025 model, mostly to tune it at a level of trading the continuation. But remember, I will always talk about how to trade below the opening price. That's trading the reversal point, the starting point of the candle, trading that reversal point. But in this example, I will talk about this continuation, this retracement to this other block, and how it's aligned with the 3 a.m. to the 4 a.m. model, how it's aligned with that model, and how we deliver correctly to the buy side liquidity. The purpose is showing you that in cases like this, you use this narrative when it's aligned with your time in price where you're looking for your entry. Let's say when price was running out this sell side liquidity, it was during the 3 a.m. model. You know that this is just a run on the sell side liquidity. You're just looking for a shift in market structure, and your next draw on liquidity is going to be this swing high. This is how to apply it correctly. Now, in this day, because this is the daily candle, the example, which was a trade which was identified on GBP USD before playing out. In this trade, this retracement to this auto block was during the 3 a.m. model. That was why this example is going to be based off the continuation above the opening price. Always remember you are aligning it with your entry time frame and your entry model. Either you trade the London section, the New York section, or you trade both, or you trade the 3 a.m. to the 4 a.m., which is based on the London section, or you trade the 8:30 to the 10 a.m., which is based on the New York section. Those are those 60-minute windows where price is mostly going to deliver a fair value gap that will lead to a complete delivery of price in that section. That's why those time are very important. Now moving to the entry time frame. So in a trade idea, as it's been explained in the table, which was showing on how to align your time frame correctly, this is an intraday setup, and we use the 1 hour trend to identify significant reference point where we'll be looking for a continuation of that bias from a discount price, which means our entry time frame is going to be the 5 minutes. The 5 minute time frame, you can see the retracement or the block. Here's the other block, swing high and the swing low of the other block. Retrace to the other block. London section starts from this green area to the close of this green area. Here's the London section, and here's the New York section. The buy sell liquidity is the previous day high, which is our overall target. Oh, sorry, the buy sell liquidity is a 1 hour swing level, which is this swing level, this high. So a buy, anticipated price to run this high. The next 1 hour swing level from this price trend is the buy side liquidity before the previous day high. So first, I do trade the London section completely from the 2 a.m. to the 5 a.m. But the 3 a.m. to the 4 a.m., I'm anticipating a fair value gap that will lead to a full delivery to my next draw on liquidity. That was why it was well known as the silver bullet entry model. It's a well known model through YouTube and other places. So from the London section, opening of the London section, price traded lower, took out sell side liquidity, created a shift in market structure, trade higher, created a shift in market structure, running out this equal highs, closing above the high. Even a run on those highs is a shift in market structure. You can identify a fair value gap, an order block, retracement to the other block. This is your entry. You're entering where you're placing your stop at this swing low. And your target is to see price trade to the next 1 hour draw on liquidity, the buy side liquidity. You can see how price deliver correctly. We got to the 3 a.m. So here's the 3 a.m. opening candle. There's down close candle that traded back to the other block, but did not actually tap to the other block, just traded back. Did a trend continuation, took out this high, closed above, fair value gap. Now here is your 3 a.m. to the 4 a.m. entry model. Set the limit order at the fair value gap. Price retrace to the fair value gap, respected the fair value gap, traded higher, retested this other block. Here's the change in state of delivery. Price retested the other block. Stop losses at this swing low. If you're entering from this other block, swing low, respected it, created a high, then you can throw your stop to this to below the other block. Sorry, I say the other block. Below the fair value gap, the 3 a.m. to the 4 a.m. fair value gap. Now price formed another fair value gap within that time range of the 3 a.m. to the 4 a.m. entry model. Retracement back to the fair value gap, respected the fair value gap, traded higher. Now, trailing your stop must be below this fair value gap to your target. And always remember to have a fixed reward to risk ratio where you'll be taking some trades off, like going in with a complete 1%. At some levels, you'll be taking off a small portion of those profits. Those help in capitalizing on trends before the trade against you. Like if I enter my trades, when it runs a 1 to 3 to a 1 to 4, I do close half of the position, then I manage that half of the position to my overall target. Those is to lock profits down. Mostly when I'm in a drawdown, I lock in those profits to cover up my drawdowns. So fair value gap still in that 3 a.m. to the 4 a.m. price range. Entry, buy, stop loss below the swing low, target the 1 hour swing level. And you can see how price delivered to the target before the New York section. Now during the New York section, if we're to go back to the first image, during the New York section, there's supposed to be a retracement to a reference point before anticipating more higher prices, which is the time price took out this buy side liquidity. But price did not retrace to this fair value gap during the New York section. So that's why I'm not doing an example of it. This was after the New York section during the 10 a.m. to the 11 a.m. silver bullet. The price traded to this fair value gap, delivered correctly, and took out the previous day high. But you can see how price ranged because the mid time frame is not showing another expansion from a discount level. Now price at a premium level. You wait for price to trade back to a discount level if you're looking for higher prices, which you can see how price traded back to a discount, buy higher prices, run on the high. The same example goes to this. Price traded from the sell side liquidity, created a swing high, discount, buy at a discount, at the other block, premium, discount, buy to a premium back again. So you need to know when a trend is at its highest point to wait for that retracement. You're not just in a motion that, okay, yes, I'm in a buy delivery, price delivering higher prices, which mean both section I'll be looking for higher prices. No, price already took out a buy side liquidity. The chances of price trading higher is now lower than the chances of price doing a retracement to a fair value gap within the London section. So these are the narratives you need to have in place to trade any model. Every model do work if you know the narrative to that model, which I will try my best try to change 25 to go through the majority of the model, which you need to do your own work personally to do the back testing to gain more narrative and gain more understanding on how to anticipate price and know when to wait or when to trade. So a classic sell day, as explained in the classic buy day, but this is going to be the opposite of what we explained from a classic buy day. A classic sell day, the accumulation price trades above the accumulation price. Stop losses will be below the opening price. Price reversed, manipulation phase, run out those stop losses distributed correctly to the previous day low as an open, high, low, close. So you understand the logic of why it's called a manipulation phase. Because from the accumulation, price trades above the accumulation, where traders are looking to buy, traders are not looking at price the same way you're looking at price, doesn't have that narrative you have, will be placing their stop losses at the opening price. Trades below the opening price, run out those stop losses, traded lower, which is a distribution phase to the previous day low or a sell side liquidity. So in a classic sell day, where you are anticipating a down close candle, you are anticipating a trend on your mid time frame above the opening price, you run on a buy side liquidity or a trade into a fair value gap. Whatever reference point is above the opening price, you can use that reference point. In this example, trade above a buy side liquidity, trade below a shift, a structure, running out the stop losses placed below the opening price. If you look at this from this perspective, price traded fairly high. Traders that are looking to buy from this swing low to swing high from this retracement, which like a breakout and a retest, your stop losses will be at this low, below the opening price. You're looking to sell because you're anticipating a down close candle. You're looking to sell. The target should be this swing low for your first target. After you run on that, retracement, your trend continuation model, inversion fair value gap, and an order block. Retracement to the order block and the inversion fair value gap, traded lower. Another trend continuation, back to this order block, trend continuation. So the two phases are trading above the opening price on a sell day or a trend continuation. You can trade both. Make sure it's aligned with your entry time frame. You might be looking at price from the manipulation phase, or you might be looking at price from the distribution phase during your own time of entry. So this is still the same example using a daily perspective when we are anticipating a down close candle. Opening price trades above the opening price, run on this buy side liquidity, shift market structure, continuation phase, order block, pre-conservative opening candle. The reason I marked this two upwards candle was because I don't want the rectangle to obstruct the opening price line. But I'm still talking about this order block. Remember, this order block hold the change in state of delivery where stop losses was at this swing low, where price came back and took out the stop losses. Retracement to this order block is a high probability order block. Led to a trend continuation lower, price day retracement. So this fair value gap traded lower to closing price. So here are the phase. The first phase, the manipulation phase to look for your sell. Your target is below the opening price and the trend continuation phase. Now remember, the first phase you need more experience to trade it, but this continuation phase you need less experience. You just need to see the 1 hour trend align with your perspective from your higher time frame. So you grow into a point where you can understand both, but find a base level between both. Now remember, everything do have the pros and cons. There are some times where price will not even trade above the opening price, will just trade lower, do a trend continuation, and trade lower. But there are some example the price will only trade once to run a liquidity or trade to a liquidity above the opening price and those trade lower directly to the previous day low or to your daily targets. So there are pros and cons, but remember that we are not looking for it to work 100% of the time. We're just looking for those times where everything is aligned with our perspective and with our trade plan, and we're looking for those bread and butter setups. So I'll be going down to the 5 minute time frame to talk about this shift in market structure from this other block above the opening price. You can see these are the times where the trend continuation still goes above the opening price and is sell in the classic sell day because it's aligned with my entry model. So this is why I told you guys that you need it to align with your entry model before knowing what you're looking for. So in this entry model, I know I'm looking for price to trade to the other block, price to trade to the other block, shift in market structure, retracement to this other block, a sell, retracement, other block, sell, anticipating lower prices. Now, the sell side liquidity is this swing low. Here's the target because from this 1 hour swing level where price traded created an equal low liquidity, the next drawn liquidity it should be for price to run this sell side liquidity and run this sell side liquidity, which you can see the example retracement, fair value gap, retracement, order block. These are the points where you are executing your trades, selling, selling lower prices. The New York section price haven't traded to our Next, draw on liquidity on the 1 hour time frame, which means you are anticipating the model to deliver more lower prices, looking for your entry at those reference points, fair value gap, or the block to deliver lower prices to your sell side liquidity. These are the times where both sections are fully aligned with your bias, where you're not waiting for a retracement to a fair value gap or anything like that. But here's a 3 a.m. to the 4 a.m. fair value gap. You can see here's a 3 a.m. candle, led to lower prices, fair value gap, retracement to the fair value gap, led to lower prices, the 3 a.m. entry. And here's the 8:30. Here's the 8:30 traded lower, fair value gap, retracement to the 8:30 to the 10 a.m. entry model. You can see there's still another fair value gap and there's still another fair value gap, but you can understand that you need to do your own personal back testing to see more examples like this. But to let lower prices traded lower, since there's no high impact news, the 7 a.m. to the 8:30 gives this fair value gap, which should have been your first entry because there's no high impact news at 8:30. It should have been your first entry. Lower prices took out the sell side liquidity. Now you can go through this model a few times, go through this lecture a few times to make sure you build a trade plan around these basics I'm explaining, the baseline I'm explaining. Build your trade plan from this baseline I'm explaining. Use it from a weekly perspective, from a daily perspective, from a scalping perspective, from an intraday perspective, whatever perspective you choose to trade from. Just build your baseline from this perspective. It's very important because this is the 2025 model. Whenever you're sending me a screenshot that is not aligned with this model, I'm mostly going to call you out on it and tell you to show me your trade plan and show me based off this idea that okay, my entry was from a trend continuation from the 1 hour time frame after price did the manipulation above the opening price, or my entry was from the manipulation from the opening price. So I already break it down levels by levels, phase by phase. What phase am I looking for my entry? What phase am I looking for my target? On a sell day, you're looking for a premium price to sell from. On a buy day, you're looking for a discount price to buy from. Those are the baseline. Watch this video a few times to understand it more better. So that's all for this lecture, and that's it's the whole narrative of the 2025 model. That is the model. What I just explained in this model is what I'm always going to be repeating throughout this 2025 model. It's nothing more than this in 2025. I might show you more time frame modification you can make. You can customize those time frames to your own perspective, which I'll be showing you more example on how I use the 1 hour time frame to enter on a weekly candle perspective. There are many examples, there are many ways you can switch this to your own personal preference, which you even saw the examples from the 1 hour time frame where you should have executed on the retracement to the order block or the retracement to the fair value gap to aim for those 1 to 2 or 1 to 3 hour trades. There are many ways you can customize it. This is just the baseline for you to know the steps needed to result to your trade entry or whatever way you do enter your trades. Those are meant for you to customize and those are meant for you to develop on. I'm only going to be showing you examples. With the examples, it's going to come from multiple time frames or multiple currencies because I'm trying to build up more examples to talk about unfamiliar circumstances in price or unfamiliar market when there's a consolidation, how you can adjust to it, and try to explain as more I can on the 2035 model. But remember, you need to do the work. You can't rely on my examples alone. You need to do the work. My example is to show you and try to answer some questions you have on price, that those examples will be answering those questions. So that's all for this lecture. See you guys in the next lecture.